Imagine this, your grandkids or great-grandkids are able to go to the finest college that they can get into without having to worry about the money, or they're able to start their own small business thanks to the smart financial choices you made with them in mind. If you have kids, grandkids, or great-grandkids and you'd like to make an important difference in their futures, keep watching. This video is all about multi-generational investing or investing for your future generations. I'll share smart investment choices that you can make that'll benefit your family, your loved ones for years to come. Hi, I'm Clark Atterbury, financial advisor. For the last 30 years, we've been helping individuals, families, and small businesses manage their investments and work toward their financial future. Let's start with the fundamentals. Investing for future generations is all about understanding long-term growth. Think of it like planting a tree. The earlier you plant it, the longer it has to grow, develop deep roots, and to bear fruit. Similarly, when you invest early, you give your money more time to grow through the power of compound interest. I'm talking about the kind of growth that can make a huge impact on your family's financial future. Let's talk about compound interest, a concept that Albert Einstein is said to have called the eighth wonder of the world. It works like this. The returns you earn on your investments get reinvested, which earn more returns, which in turn get reinvested, and so on. It's like rolling a snowball down a hill. It may start small, but it gets bigger and bigger the more it rolls on. That's the power of compound interest working for you, and the longer you have, the better. Picking the right investments or combination of investments for your long-term multi-generational portfolio will have a huge impact on the outcome. Whether the investment's earning 3% or 6% or 9% or whatever will make a huge difference in how that money grows over the decades. Take a look at this chart with me. This chart shows the performance of different kinds of assets over a 100-year period of time. You can see how $1,000 invested in different portfolios at the beginning of that 100 years grew over the 100 years. A portfolio of bonds grew to $98,000. That same $1,000, had it been invested in the S&P 500, would have grown to over $10 million. Now, I want to point out to you that had you been invested in that same portfolio of stocks, you would have had to endure dozens of significant market downturns along the journey. The bond portfolio, as you can see, was considerably less volatile. So the investments that have less volatility have paid less historically, while the investments that have had the highest rates of return historically have come with a price to pay, which is to endure that significant short-term price fluctuation. Let me zoom in on this for you and ask you this one simple question. If your great-grandparents had been investing for you 100 years ago, which portfolio would you have wanted them to put their money into with you in mind? The role of time in investing can't be overstated. With a longer time horizon, you have a greater ability to ride out the market's ups and downs. This means that you may be able to take on the kind of investments that, while they have greater fluctuation in the short term, have given investors higher rates of return over the long term. For investments made for future generations, we're often talking a time frame of decades. This long-term approach allows you to focus on the big picture, the horizon, rather than the short-term market swings. You'll want to build a diversified portfolio so you're not putting all your eggs in one basket. You can use index funds or mutual funds, etc., to diversify your portfolio. Spreading your investments across multiple asset classes reduces the risk of a significant loss. If one investment in your portfolio is not having its day in the sun, hopefully another investment in your portfolio is having its day in the sun, balancing your portfolio. The key is to end up with a portfolio that you understand and can live with over the long haul. Having said that, you need to keep an eye on your investments and to review them periodically and to make adjustments periodically. The markets and the economy are constantly evolving, and you might need to make changes to your portfolio from time to time to keep your portfolio in line with your objectives. If you're a do-it-yourselfer, you'll want to keep your eye on the ball, make the reviews and adjustments yourself. If you're the kind of person who likes help managing your investments, well, that's the service we provide to our clients. Reach out to us to see if we might be a good fit. Once you've selected the best investments or combination of investments for your portfolio, the next thing to address is the type of account to hold them in, or how you own them, how you title the accounts. Tax efficiency is a huge part of investing for future generations. Using accounts like 529s or Roth IRAs can offer significant tax advantages. For example, 529s allow your investments to grow tax-free, and withdrawals for qualified educational expenses are tax-free. Roth IRAs offer significant tax advantages for you during your lifetime and for your beneficiaries after you're gone. A trust account is another type of account to consider that allows you to make sure your money goes into the right hands at the right time according to your wishes. Investing for your family's future generations is one of the most meaningful steps you can take. It's not just about building wealth, it's about creating opportunities and providing security for your loved ones. Open communication about your plans and goals makes sure that everybody's on the same page and creates a sense of shared vision. Are you investing for your kids, grandkids, or great-grandkids, or did your grandparents invest for you? Let us know in the comments. For more on long-term investing, watch these videos next.